welcome to the August version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you everyone for taking time out of your day to join us. If you have any questions during our presentation today, please write them in the chat and I will ask them to Chris if they are timely. Otherwise, we'll get back to you directly or address it in our next MSOM. This month's edition is titled Summertime Swingin, where Chris will walk us through the latest market updates, portfolio positioning, and the confirmation bias. Take it away, Chris.
Thanks, Adam. Summertime swinging. Many of you are probably wondering what that means. So Sahm-er is a rule where if the unemployment rate rises by more than 50 basis points above the 12-year average, it is an indication of an upcoming recession. Can you go to the next slide, please? The swingin part of our title referred to the volatility that we saw in the most recent month. To start August, the S&P 500, the NASDAQ, and the Dow Jones Industrial Average saw their worst three-day decline since 2022. Across the sea in Japan, the Nikkei index had its worst day since 1987, dropping 12.4% on August 5th, our civic holiday here in Canada. The fear index, commonly known as the VIX, hit over 65 on August 5th, the highest level since the pandemic when we were experiencing rolling lockdowns across the world. The 10-year yield as investors fled to fixed income, and the US topped us off with that poor unemployment print, the highest since 2021. That triggered that Sahm rule where we saw the current 3-month average unemployment rate fall below that 12-year rolling average by 50 basis points. And you can see that has led to recessions more often than not and an increase in the unemployment rate. We'll be watching very closely to see if this uptrend in unemployment continues as we move towards the winter months. What took center stage was what was commonly referred to as the carry trade. This takes place when investors borrow in a low-cost jurisdiction and invest in another jurisdiction where they see higher upside return. The Japanese currency, the yen, have been one of the places that this most commonly takes place. Japan has experienced a lost decade from a period of extended low inflation to deflation. This has caused their central bank to lag most others across the developed world in our interest rate hiking regime. They have held steadfast to that until most recently when the central bank came out talking about a rate hike. They quickly reversed course, albeit, but that was enough to spark a rally of over 14% in the yen from July 10th to August 5th. This carry trade was most popular amongst technology investors, where people would borrow yen and invest in the NASDAQ and those high-flying tech stocks. So as that yen unwound, so did the NASDAQ. We're showing that in the chart here on the right. That took place for the period from July 10th to August 5th and climaxed on that civic holiday. As many of you may have been having a cocktail on the dock, Adam and I were glued to our screens watching the market meltdown with that VIX index peaking at 8:30 a.m. on August 5th. The other aspect of this is that as the yen depreciated, it made that debt investors were borrowing less expensive. The reverse is true. So as the yen increased, those investors need to unwind this trade to pay that off before they couldn't afford to pay the borrowing costs from borrowing that yen. So that it expedited the situation, and we saw one of the biggest sell-offs since the pandemic based on the speed and velocity of what took place. Next slide, please. We've long talked about our tactical asset allocation approaches, and this was fortuitous in also how we managed through a rigorous process. Every month, our team takes place in an investment committee meeting where we bring investment professionals in from around the world to help support our process and test our views. On July 8th, we had our monthly investment committee meeting and discussed the fact that the fear index, the VIX, was sitting at a historically low level and suppressed for an extended period of time. You can see that in the chart on the bottom left. That lull right before the latest spike showed us a level of complacency in markets. This was taking place while we were seeing weakness in the job market, as we have talked about on the earlier slide, as well as expectations for further monetary easing being pushed out into the future. That meaning the Fed cutting rates to help support the overall economy. Expectations continued to fall as to the size and frequency of those cuts. All of this, coupled with that yen carry trade, led to that sell-off. But fortuitously ahead of it, because of that complacency we were experiencing in the market, we decided to take some risk off the table and move some cash to the sidelines just in case we saw some sort of climatic event where we'd be able to buy the dip and put those proceeds back to work. In the days following the meeting, we trimmed our position in the Fidelity Global Innovators Fund. That fund has been up 83% since October of 2022 and almost 50% by the end of June of this year, year to date. We also trimmed our long-term government bond ETF as the US 10-year yield had drifted lower. After peaking at 4.95% earlier this year, it had moved down to 4.09 at the end of July and even further up to this point in time. We also added to a managed futures fund that's designed to outperform during strong moves in the market, whether the direction is up or down. Next slide, please. As well, in our US top picks mandate, we sold a part of our position in Tesla, which had rallied quite strong into July. And we also had trimmed our position in NVIDIA down to just 3% from having it as high as 9% in previous periods. We then also, later in the month, after the sell-off had taken place, took profits from some of our more value-oriented picks like AbbVie, Cheniere, American Tower, United Health, which drastically outperformed during that sell-off, to rotate into a new name in Eli Lilly. Eli Lilly has been a market standout because of its GLP-1 medication and is becoming an emerging leader in the fight against Alzheimer's. This is a stock we have long loathed to purchase, but has just not given us that opportunity. During that period of time, it fell over $100. We entered the position and it has already recouped basically all of those losses. This is examples of how we are continuously monitoring our portfolios and repositioning as times are changing. And as the facts change, so do our opinions, as the great Keynes once said. Next slide, please, Adam. As we've been doing in recent months, we'd like to highlight another one of the well-known behavioral biases, the confirmation bias. This is when investors tend to focus more on information that agrees with their existing beliefs and dismisses opinions that goes against it. Many of you would experience this with inside your social media or Facebook accounts as you see more and more things push towards the things that you seem to like or click towards. The main three aspects of this is research. People often seek out information that supports their view. Many times when we're looking at stocks that we want to purchase, we actually read research reports that are the most contradicting to the thesis that we are trying to buy into to make sure that we aren't missing any information. Interpreting complex events in a way that support your view, and then remembering only the parts that validate your beliefs. All of this adds up to this confirmation bias, which can be extremely detrimental to investors because it gets them into a concentration risk. And when things happen, they believe that it is taking place because of how they are seeing the world. This is very similar to what happened during this sell-off, as investors thought that the chances of a recession were coming. And once those that yen carry trade was unwinding, that cooperated with their view and intensified the selling as we saw, and expectations of a pending recession went through the roof. All of that unwound quite quickly, and things are pretty much back to normal as we're seeing near all-time highs in both here in the United States as well across in Japan, shown there by the Nikkei 225 index. It's very helpful to be able to understand these biases, to protect against them, and work with us, your trusted advisor, to make well-informed decisions.